There are some investments that can make you money very quickly. We saw that happen with Amazon and Apple and Tesla during the tech boom. And then there are other investments that you want to own for life because these are things that can build you generational wealth. What's up, everybody? I'm Jaspreet Singh from theminoritymindset.com, where money minds rethink rich. When you spend money most of the time, you are a consumer. Like if you go out to McDonald's and you buy a burger and you buy some fries and you eat it, you are consuming their products. When you invest your money, you become a producer. Now instead of you being the person that's buying the burgers, you're the one that's selling the burgers. Speaking of McDonald's, one way to do that is by actually investing in and buying one of the McDonald's franchises. Now you own a McDonald's store, so if people are buying McDonald's sandwiches from you, you're the one making money. The other way you can do that is by investing in the McDonald's corporation, the actual stock. If you go onto the stock market and you buy one share of McDonald's, you become one of the owners of McDonald's. Now, if you just own one share of McDonald's, you're not going to get to tell them what to do and how to run their business, but you do get to share in the profits when McDonald's makes money. Now, the difference between being a real investor and being a flipper or a trader is how long you plan on owning your investment for. Like if you stick with McDonald's, if you plan on just buying and selling their stock in 3 months to make a quick profit, you're not an investor, you're a trader. If you plan on owning this investment for longer than a year, now you're classified as an investor. So if we draw this out, when you invest your money, you are using your money to be a producer, not just a consumer. Remember, when you're a consumer, you're just eating the product or using the product. When you're the producer, you're the one that's making money off of the product. So you're investing in being a producer, and when you invest your money, you have a time span of having your money invested for at least 1 year. What I want to talk about in this video is not just your regular investments. I want to talk about the investments you should be holding for your entire life because they're a little bit different than what you might think. I'm going to be going over 5 different investment types in this video, so make sure you watch this video until the end. But before I get into that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. The first is real estate for residential purposes for reasons that you might not expect. Now, when I say real estate for residential purposes, I mean real estate where people live in. So this can be homes or apartments. I'm not calling it residential real estate because when people say residential real estate, that typically means we're talking about single family homes or small multi-family units up to 4 different units. When I say real estate for residential purposes, this can mean single family homes, or this could mean big apartment complexes where people live in. The way real estate investing works is like this. Let's say you find this house right here on sale for $100,000, and you go through the property and you think it's a good property in a good area. So then you come in, so I'm gonna draw you right here, and I'm gonna draw you with a nice mustache, of course. You come in and you buy this property for $100,000. Now you own this home right here, but you're not gonna live in this home yourself. Instead, what you do is you are going to lease this home out to this person right here and maybe their family, and they're going to live in your property, but in exchange of this person living in your property, they're going to pay you $1,000 a month in rent every single month for them living in your property. Now, you can continue working your job like normal, or you can go on vacation or do whatever you got to do, and you will continue making this $1,000 a month every single month because this person needs a place to live, and where they're living, they're living in your home. The reason I say you want to own real estate for residential purposes for life is because people will always need a place to stay no matter what happens in technology and no matter what happens in the future. People will always need a home. You can compare that to the past, where people used to look at shopping malls and strip plazas as the thing to own in real estate. Well, as technology came and Amazon came and the shopping dynamic of the world changed, then shopping malls didn't become as attractive. There were people who made a ton of money in the strip mall and the shopping mall business. But now that industry is kind of dying because the whole shopping industry is changing. Same with office real estate. Real estate investors back in the day used to say that companies will always need a place to work. But then came the 2020 pandemic, and then people realized that they can work from home, which made office real estate not so attractive. Residential real estate is a little bit different because people will always need a roof over their heads. People will always need a bed to sleep on, and people will always need a home to stay in. That makes it a lot easier for you to own real estate for the rest of your life, because the only reason people won't want a home to live in is if people decide that they're more comfortable living on the streets. Now, let's talk about why you don't want to own real estate for the rest of your life. So for the sake of this example, let's say over here you have a single family home and here you have an apartment complex, both of which you can buy for $1 million. And let's assume, for the sake of this example, that if you rented out both of these properties, after paying all of your expenses, you would be left with $70,000 at the end of a year. So you buy each one of these, and each one of these make you, let's just say, $200,000 a year in rental income, and then you pay for all of your expenses, your property taxes, your insurance, your maintenance, your management fees. After paying all of your expenses, you are left with $70,000 worth of profit, and we're assuming that there's no debt. You're buying these properties with cash only. That means both of these properties are paying you a 7% annual return, because here you're buying this house for $1 million and you're making $70,000 a year in rental income profits, and here you're buying this apartment complex for $1 million and you're making $70,000 a year in profits. But you also have to remember that just because you made $70,000 doesn't mean you get to keep $70,000, because the IRS wants their cut. You gotta pay taxes on this money. However, real estate does come with some legal tax loopholes. When you own real estate as an investment, meaning you're not the one living here, you are renting out your property to somebody else, then you get to tell the IRS, hey, this property that I own is 1 year older, so I deserve a tax break called the depreciation deduction on my taxes. And so you get to take a tax break on both of this income right here because you own investment real estate. But the size of your deduction is going to be different here and here, because this single family home is considered residential real estate and this apartment complex is considered commercial real estate. Residential real estate, so single family homes, 2 families, 3 families, and 4 family units, let you depreciate your property for 27.5 years, while commercial real estate, so anything over 4 units, lets you depreciate this property over 39 years. I'm going to explain what this means. So now what you're going to do is you are going to take the value of this building, not the land, the building itself, and divide it by the number of years that you can depreciate it on your taxes. So for the sake of these examples, let's assume that when you buy this $1 million property, $200,000 of which is going towards the land value, because these properties sit on some land, and $800,000 is for the building. So you're paying $200,000 for the land that this property's on, and $800,000 is for the actual building. Once you know that, now you can do $800,000 divided by 27.5, which is, $800,000 divided by 27.5, $29,000. So over here, you get a $29,000 tax break every year for 27.5 years. And over here, $800,000 divided by 39, this is about $20,000. So here, you get a $20,000 tax break every single year for 39 years. What this allows you to do now is you buy this property, you make $70,000 a year, but you only pay taxes on $79,000 minus $29,000, so right around $41,000. You're only paying taxes on $41,000 worth of income for the first 27.5 years. After 27.5 years, you don't get this deduction anymore. Same thing here. Here, you make $70,000, but you only tell the IRS that you made $50,000, and you get to do that for 39 years. After 39 years, you don't get that deduction anymore, which is why a lot of people invest in real estate, but they have the goal of never holding it longer than 27.5 or longer than 39 years. However, you also get some benefits if you own real estate for your entire life. So this is the reason why you wouldn't want to own real estate for your entire life, because after 27.5 years or after 39 years, you no longer get this tax break, and so now you have to pay more money in taxes. And so if you don't want to pay more money in taxes, you might want to sell your property after 27.5 years or after 39 years. That way you can take advantage of all these real estate tax breaks. However, let's go over why you might want to own real estate for your entire life. So now, same example. You buy either one of these properties for $1 million and you own it for some time and you're making rental money every single year. But now a few years go by and you find out that your property is now worth $5 million. So you got a lot of equity in this property because you bought it for $1 million and now it's worth $5 million. And now you're thinking, yeah, I want to give this property or this money to my kids. Now, one thing that you can do is you can sell this property and get $5 million worth of cash, but now you have millions of dollars worth of profit because you bought this property for $1 million and you're selling it for $5 million. So you're going to have a pretty big tax bill where you're going to have to give a big chunk of this money to the IRS in taxes. The alternative, assuming you do not sell this property for cash when you're alive and you own these properties, either one, until you die. Now, when you die, your estate gives this property, either one, to your heirs, your kids. Now, what happens is your kid is going to get this property and the government is going to say that your kid got the property, they bought it for $5 million. So if your kid went out and they sold this property today for $5 million after you die, they will get this $5 million of cash, and they don't have to pay any taxes on this money because to the government, it looks like they bought the property for $5 million. This concept is called stepped up basis, and essentially what it's saying is if you die with this property, then the person you give this property to essentially can say that they bought the property for how much it's worth when you die. So now if you get here, you don't have to worry about selling your property for a profit and then paying taxes and then giving this cash to your kid. What you can do is let this property live with you for the rest of your life, and then when you die, you give this property to your kid, and now what you have to worry about is estate taxes, but you get a much bigger kind of cushion with estate taxes because you have to be gifting millions of dollars before any estate taxes come into play. Now I do gotta let you know, although I am an attorney, I am not your attorney, so if you have specific tax questions or legal questions, talk to a professional in your area. The last reason why I say real estate is an investment that you wanna own for your entire life is because with real estate, you own something tangible that you can see, feel, and touch, and this is something that can continue to provide you income and income growth for the rest of your life, because if there's demand for this property, wherever it is, then what you're gonna see happen is more people are gonna wanna live there, which means the rent that you charge can go up too. So now as things become more expensive because of inflation, the amount of money you make every single year also increases because there's more demand to live in the property that you own. The second thing you wanna own for life is the stock market in general. And when I say the stock market in general, I don't mean investing in stocks the way most people talk about investing in stocks. I talk a lot about investing on a YouTube channel, from real estate investing to stock market investing, which is why if you haven't subscribed to our channel yet, you should do that. But when most people talk about stock market investing, they're trying to find the next hot stock. How can you find the next Tesla or the next Amazon or the next Apple before it makes it big? Now, you can make a lot of money if you find the next hot stock, but that might not be something you want to own for the rest of your life because, well, Tesla could fail, Amazon could go bankrupt, and people might stop liking iPhones. Now I know what you're probably thinking, oh, Jaspreet, Amazon can't ever fail. They're a powerhouse. How could anything be bigger than Amazon? Well, that's exactly what people used to think about Sears. Sears used to be the monster retailer, and back in the day, people used to think that there would never be a Sears competitor because they were so huge. Well, now times have changed, technology has changed, and Sears is bankrupt. Companies will change, technology will change, people will change, but one thing, if you believe in the United States and if you believe in the American economy, one thing that won't change is the economy. So if you believe in the American economy, what you want to be betting on is the American economy, because while companies like Sears might come and fail, and JCPenney might come and fail, and Circuit City might come and fail, and Hertz might come and fail, and California Pizza Kitchen might come and fail, the American economy has continued to grow. The closest way for you to get actual exposure to the American economy is to invest in the broader stock market as a whole, and that would be through funds like VOO and SPY. These are two different ETFs, exchange traded funds, which allow you to invest in the broader stock market because both of these funds give you exposure to the top 500 companies in the United States. So both of these funds give you exposure to the S&P 500. Now I want to give you a little caveat here because the United States economy and the stock market are similar but two different things. The economy is the economy. This is our companies, and this is how many people have jobs, and this is how well our economy is doing. The stock market is where people bet their money based off of how well they think the economy is doing. So while they're similar, they are different because when people put their money in the stock market, they're betting that the economy is going to do well in the future. The way you invest in these funds is the same way you invest in any other company. You just go into your stock brokerage and then buy these funds as opposed to buying something like Tesla or Amazon. Now, I should also remind you that when you invest your money, you are never guaranteed to make money. You might even lose money when you invest, which is why you should always do your own due diligence and never blindly listen to a random guy on YouTube. But when you invest in funds like these, now what you're doing is you are essentially betting on the growth of the American economy. You're not trying to get rich overnight. You are just betting on the slow and steady growth of the economy. If the economy is growing and our companies are growing and companies are making more money, well then chances are these funds are going to continue to make you more money too. By the way, if you do want to learn more about how to actually invest your money in the stock market and grow your money and find a good stock brokerage to use, our team put together a very comprehensive article that goes over all of that, and you can read it on our website, theminoritymindset.com, and I'll also link it for you in the description below. The advantage with owning something like this for the rest of your life is now you don't got to worry about changing trends because, like I said before, companies will change, people will change, and technology will change, but the economy will continue to grow. So as companies come and go, these funds will kick out the companies that are not doing too good, and they will add in the companies that are doing better. So if a company is no longer one of the top 500 companies, it will get kicked out of these funds, and then these funds will add in a new company who is now one of the top 500 companies. Now the difference between owning something like this and owning real estate is with real estate, typically you're investing in real estate for passive income. So you're going to make your investing decisions based off of how much money you're making every single month. Here, you do get some passive income from dividends, but it's not going to be as much as the amount of passive income you're getting from real estate. However, you do get the stepped up basis here like you did in real estate. So if you invest $1 million here and over your lifetime this goes up to $5 million, well, you could sell your investment and pay taxes and then give this money to whoever you want to give it to. Or you can own these investments for the rest of your life, and if you don't have to use this money and you die with these assets, well, now they can go to your kids or whoever you want it to go to, and they will own these assets. And when they sell it, if they sell it for $5 million, which is how much it's worth when you die, they won't have to pay any capital gains taxes on that. The third thing you want to own for life is gold with an asterisk, because this should be a small part of your portfolio, no more than 5 to 10% of your entire portfolio, because gold is not there to make you wealthy. It is there to protect you against a worst case scenario type of situation. Your stocks and your real estate are what you own to fund your retirement, to create more passive income, and to build your wealth. Your gold is almost like financial insurance. It's there to protect you against something horrible happening in the economy. There's a few different ways that you can invest in gold. You can invest in companies that mine in gold. Now, you're not actually investing in gold. You're investing in companies that mine in gold. And as gold prices go up, these companies make more money because there's more of a demand for gold. Or the second thing you can do is invest in gold certificates. So now you're investing almost like gold stocks. You're investing in a fund that gives you exposure to actual gold. So a company owns physical gold, and now you're investing in a fund that this company created, which gives you exposure to their actual gold. So it's a little bit of a derivative, but it gives you exposure to physical gold. And the third thing that you can do is invest in physical gold bars. So if we're talking about owning gold, the ideal thing to do is own the physical gold bars, because that gives you the most insurance, because this is something you can see, feel, and touch, and it's something that you can control. Again, this should not be a huge part of your portfolio, and this should not be something you're stressing about. And if you don't have any other investments, you should not be worried about buying gold right now. The first thing you need to be worried about is buying the real estate, buying the stocks, buying the things that are actually going to make you money. Once you establish yourself, and once you have some real financial assets, that's when you can think about adding some gold, remember asterisk, adding some gold to your portfolio. Gold comes in handy in worst case scenario type of situations. So when we talked about investing in stocks, we're betting on the American economy, because if the economy continues to grow, well, then the stock market is going to grow. But if the economy completely fails and our dollar becomes worthless and people have no money, well, this is where gold could have value. Gold is the original currency, and a lot of people believe that if the dollar were to fail, then people would revert back to gold. If you remember back during the Great Depression, there were countries in the world that saw hyperinflation, where people would have to take literally a wheelbarrow full of cash in order to afford a loaf of bread, because then gold became so expensive. And so the thought is, if the worst case scenario type of situation happened and the economy crashes and the dollar goes to nothing, well, then people will go back to things like gold, because this is a tangible currency and this was the original currency. You know, people have been betting on a doomsday situation like that for decades and decades and decades, and to date, they've been wrong every single time. Which is why you want to make sure you're investing in your wealth first, but you always want to protect yourself, because yeah, there's a chance that things could go really bad, which is why you want to own some gold. Going along with that, the fourth thing you want to consider owning for the rest of your life is some cryptocurrency. So this is what's considered the new digital gold. Gold was the original currency, and many people believe that cryptocurrency and blockchain will be involved in our future currency. Now, look, there's a lot of speculation around cryptocurrency, and there's a lot of guessing around what cryptocurrency will be in the future, and nobody can predict the future, which is why, again, we got this asterisk here, because this needs to be a small percentage of your portfolio, okay? This is not something you want to bet your entire life savings on. This is something where you want to put some money, because there's a lot of potential with cryptocurrency and there's a lot of potential with blockchain. However, there's a lot of uncertainty around it. Again, this should not be your first investment. Get the things that are proven first out of the way. Own your stocks, own your real estate, own the things that are going to make you wealthy and pay you with passive income. Then once you do that, you can put some money here. And fifth, the last investment we're talking about that you want to own for life are commodities that you need to survive. So one way to kind of think about this is you might have heard examples of super wealthy people and rich people that have these bunkers in their homes that protect them against any nuclear blasts. And inside of these bunkers, they have food and rations that will survive them for years. Now, I'm not saying you need to spend $1 million building an underground bunker below your home, but you should consider investing in some commodities that people will need to survive. So one example of this is water. If you've ever seen the movie The Big Short, great movie by the way, which talks about the 2008 real estate collapse, at the end of the movie, they talked about how this guy was investing in water because we have a limited supply of water in the world and our demand and our needs for water keep going up. We need water in order to survive. It's a commodity to survive. And so this is not something that's going to make you rich overnight. But if the demand and the need for water go up and our supply of water is limited, well, this could create a real problem in the future. And so you want to be kind of a proactive thinker and start thinking about things on how to take care of yourself and your finances in this case. And one way that you can get exposure to that is by investing in, again, companies that clean or store water, or investing in water ETFs that give you exposure to the water commodity. Another thing that you can potentially consider is, okay, investing in a farm, an actual farm for your family, just in case, because we never know what's going to happen in the future. I mean, we have a lot of tension in the world, and let's say things go bad. If you have a farm, well, now you can kind of be self-sufficient. You can grow your own food and have things to take care of yourself and take care of your family. Again, this is a commodity to survive. Is this something that's going to make you rich overnight? No, but you're protecting yourself against anything. If you enjoyed this video, here's a video that I think you'll love, and while you're at it, subscribe to our YouTube channel and join our free finance and business newsletter. And as always, keep hustling. Passive income now is not a way to get rich quick. There is a lot of misconceptions out there